Picture waking up knowing your investments are paying you $5,000 every month, enough to cover your bills without a paycheck. Sounds like the dream, right? In today's video, we're breaking down exactly how much money you'd need invested in Fidelity index funds to safely generate that $5,000 per month. Hint, it's probably less than you think. Now let's dive into the numbers and strategy that can turn this dream into reality. Why $5,000 a month? In America, $5,000 per month, or $60,000 per year, is a common target for a comfortable retirement income. It's roughly in line with what many retirees spend annually on essentials like housing, food, and healthcare. In fact, the Bureau of Labor Statistics found that in 2022, retirees spent about $54,975 per year on average. That makes $60,000 a reasonable goal. It covers typical expenses with a bit of cushion for travel or emergencies. This level of income won't make you rich, but it's enough for most people to live free of financial stress in many parts of the country. Note that $5,000 a month today might not go as far in the future due to inflation. At a historical approximately 2.5 to 3% inflation rate, $60,000 today could equal about $108,000 in 20 years. Keep that in mind. If your retirement is decades away, you'll want your investments to grow and to maintain purchasing power. Like and subscribe if you enjoy content like this and want to see more. The power of Fidelity index funds. Why are we specifically talking about Fidelity index funds? Two big reasons: diversification and low costs. Index funds let you own a slice of hundreds of companies at once. For example, a Fidelity 500 index fund tracks the S&P 500, giving you instant diversification across the largest U.S. companies. Over the long run, the U.S. stock market, as measured by the S&P 500, has returned about 10% per year on average, around 7% after inflation. That kind of steady growth is the engine that makes living off investments possible. Fidelity's index funds are also famous for rock-bottom fees. High fees can quietly eat into your returns, but Fidelity keeps costs extremely low. For instance, the Fidelity 500 index fund has an expense ratio of just 0.015%. Meaning you'd pay only 15 cents in fees per year for every $1,000 invested. Essentially, investing in Fidelity index funds lets you capture broad market growth without losing much to fees. An ideal combo when you plan to live off your portfolio. Dividends versus selling shares. How exactly can an index fund portfolio provide $5,000 of income each month? There are two main ways your investments pay you: dividends and capital gains. Dividends. Many index funds, like those tracking the S&P 500, pay quarterly dividends, your share of companies' profits. However, dividend yields are relatively low for broad index funds. For example, FXAIX, Fidelity's S&P 500 index fund, currently yields only about 1.1% annually. On a $1 million portfolio, 1.1% is just $11,000 a year in dividends, nowhere near $60,000. Relying only on dividends, you'd need a massive principal, on the order of $5 million plus, to get $60,000 yearly at a roughly 1.1% yield. Clearly, that's not the most efficient plan for most of us. Selling shares, that's capital gains. The more practical strategy is following a safe withdrawal rate, which means you sell a small percentage of your portfolio each year, ideally the amount your investments grow by. This way, you combine any dividends plus some of the growth in your fund's value to generate income. Over decades, stock index funds have substantial price appreciation, historically 7 to 10% per year on average in the US market. By withdrawing a portion of that growth, you can meet your income needs and keep your nest egg intact long term. The key is not to withdraw too much. Take out too large a chunk, and you risk depleting your principal faster than it grows. So, what's the magic number you can withdraw each year? That brings us to the famous 4% rule. The 4% rule is a tried-and-true guideline in retirement planning. It was introduced by financial planner William Bengen in 1994 after studying many decades of market return. The rule says that if you withdraw 4% of your portfolio in the first year of retirement and then adjust that dollar amount for inflation each year after, your money should last at least 30 years. This held true even through tough periods like the Great Depression and high inflation 1970s in Bengen's research. It's not a guarantee, but it's a widely used starting point for a safe withdrawal rate. Using the 4% rule, figuring out the nest egg required to get $5,000 a month is straightforward. We want $60,000 per year, so we ask, $60,000 is 4% of what principal? Just divide $60,000 by 0.04. $60,000 divided by 0.04 equals $1,500,000. In other words, about $1.5 million invested is the target to sustainably generate $60,000 per year in income. If you have roughly $1.5 million spread across Fidelity index funds, withdrawing approximately 4% annually, which is $60,000, has historically been shown to allow your portfolio to support that spending without running out of money too soon. Think of $1.5 million as the financial freedom price tag for a $5,000 per month lifestyle. Another way to frame it, $60,000 per year is 25% of $1.5 million. This aligns with the classic 25 times rule in financial independence circles, which says you should aim to save about 25 times your annual expenses in investments. If you spend $60,000 a year, i.e. $5,000 a month, 25 times that amount is $1.5 million. Both the 25 times rule and the 4% rule are two sides of the same coin, giving the same target number from different angles. If you want help running your own numbers and building a plan to hit your version of that $1.5 million target, join our free Discord community, links in the description. Inside, we share trackers, step-by-step blueprints, and we do Q&A on stuff like withdrawal strategies, index funds, and how to actually get from where you are now to living off your investments. Why $1.5 million and not less? You might be wondering, do I really need a full $1.5 million? What's the lowest I could get away with? The truth is, $1.5 million is already a rule of thumb minimum for $5,000 monthly income under typical market conditions. Could you try to do it with less? Possibly, but not without taking on more risk. Withdrawing more than 4%. Say you only saved $1.2 million but still took out $60,000 yearly. That's a 5% withdrawal rate. At 5%, your money might not last because you're pulling out funds faster than historically sustainable. There's a higher chance you'd deplete your principal, especially if a market downturn hits early in your retirement. In good market years, you'd be fine, but in bad ones, you might have to dramatically cut back spending or risk running out of money. In short, 5% is pushing it. 4% is considered much safer based on past data. Dividend-only approach. As we discussed, living purely off dividends would require an enormous portfolio, over $5 million at approximately 1 to 2% yields, because broad index funds just don't throw off that much income. Some investors chase higher yield stocks or special dividend funds to lower the needed principal, but those often come with higher risk or lower growth. A balanced approach using a moderate withdrawal of total returns usually works better for long-term stability. Considering other income, the $1.5 million figure assumes all your monthly cash needs come from your investment. If you expect other income sources, you could need less saved. For example, if you will get Social Security benefits, say around $24,000 per year, roughly the current US average for retirees, that could cover almost half of your $60,000 target. In that case, your portfolio only needs to deliver the remaining approximately $36,000 per year, which by the 4% rule means about $900,000 saved instead of $1.5 million. Of course, not everyone plans on Social Security, especially if you're aiming for early retirement. So $1.5 million is the baseline, assuming just your investments fund your lifestyle. New research on safe withdrawals. It's worth noting that some recent analyses suggest being a tad more conservative than 4%, especially for longer retirement. For instance, Morningstar's latest research indicates a 3.7% withdrawal might be more prudent going forward. If you used 3.7% as your safe withdrawal rate, to get $60,000 a year, you'd need a bit more, roughly $1.62 million saved. The idea is that future market returns could be slightly lower, so a smaller withdrawal protects your nest egg. This isn't settled law, but it's a reminder that 4% isn't a hard and fast guarantee. Flexibility is important. In summary, approximately $1.5 million is the ballpark lowest amount for generating $5,000 per month in a sustainable way using index funds. It assumes a balanced stock and bond portfolio, historically yielding approximately 7% annual returns on average, and a roughly 30-year time horizon. If your situation differs, longer time frame, desire for extra safety, etc., you might need to adjust that target a bit. Planning and building your $1.5 million nest egg. Hitting $1.5 million in investments might sound intimidating, but it's achievable with a solid plan and time on your side. Here are a few practical tips to reach that goal. Start early and contribute regularly. The sooner you begin investing, the more compound growth works in your favor. Make consistent contributions to your retirement and brokerage accounts. For example, investing about $800 per month at a roughly 7% return can build roughly $1.5 million over 35 years, thanks to compounding. The exact numbers will vary, but the principle is, the more time you give your money to grow, the less you need to save each month. Max out retirement accounts. Tax-advantaged accounts like a 401k or IRA can accelerate your journey. Contribute as much as you can, especially if your employer offers a 401k match. That's free money on the table. These accounts defer or eliminate taxes on growth, which helps your investments compound faster. Invest for growth. To reach a big number like $1.5 million, your money should be working hard. That means a growth-oriented allocation, typically a heavy mix of stocks via index funds for higher return. Historically, stocks have outpaced bonds and inflation, with the S&P 500 averaging about 7 to 8% annual returns after inflation over the long term. Fidelity index funds like an S&P 500 fund or total market fund are great core holdings for growth. They give you broad exposure to the market's gains with minimal fees. You don't need to beat the market. Just riding the market's average growth can be enough to hit your target if you stay consistent. Monitor and adjust. Life isn't static. Market conditions change and your personal situation might too. Review your plan periodically, at least once a year, to make sure you're on track. If the market has a great run and you're ahead of schedule, good. Keep going, but don't get overconfident. If there's a crash and your portfolio drops, you might decide to save a bit more or postpone retirement a couple years to let your investments recover. The 4% rule is a guideline, not gospel. Staying flexible is key. When you do retire and start withdrawing, continue to adjust. If we hit a rough patch, say a recession early in retirement, you might withdraw a bit less or trim expenses for a while to preserve your capital. In contrast, in strong market years, you could give yourself a raise. The goal is to make your money last for the long haul. Keep costs low. We touched on this, but it bears repeating. High fees and expenses can drag down your returns. Stick with low-cost index funds, like Fidelity's, so that more of your investment earnings stay in your pocket. Paying, say, 1% in mutual fund fees might sound small, but over decades that could literally cost you hundreds of thousands in lost growth. An index fund with a 0.015% fee versus an active fund with a 1% fee can be the difference between reaching $1.5 million on time or not, so choose wisely. Living off $5,000 per month from Fidelity index funds is an attainable goal, but it requires planning, patience, and discipline. The lowest amount you need in this scenario comes out to about $1.5 million invested, based on the 4% rule, which has a strong historical track record. With that nest egg, you could draw roughly $60,000 per year, $5,000 per month. And let your diversified investments, mostly stocks, continue to grow enough to support those withdrawals indefinitely. Everyone's situation will differ, of course. You might need a bit more for peace of mind, or a bit less if you have other income or very low expenses. Remember that personal finance is personal. $5,000 a month is just a benchmark. What's powerful is knowing how to calculate your own number. Now you have the tools. Estimate your yearly need, multiply by 25, or divide by 0.04. And you've got a ballpark goal for financial independence. Getting to a 7-figure portfolio isn't easy, but many ordinary people achieve it by investing steadily in index funds over their careers. The combination of time, compound interest, and low-cost diversified funds is extremely powerful. So start where you are. Automate your investments, keep your spending in check, and let the market work for you.